As we go to air tonight, European markets are again on the slide, with Italy sucked into the continent's debt crisis. Finance ministers are meeting in Brussels to discuss a second Greek bailout, but again find themselves behind the curve. The prospect of a crisis in the Eurozone's third largest economy has the markets in a tailspin. Italy is simply too big to bail. Rebecca Hyam reports.
Until now, Italy, with its massive public debt, has managed to stay below the radar, but no longer.
They've got an economy 6 times the size of Greece's. They've got the biggest bond market in Europe, and their debt to GDP ratio, forget about the deficit, if you look at their debt to GDP ratio, it's about 120%.
The Italian economy, with GDP of $1.8 trillion dwarfs the joint IMF European Union Rescue Fund, and that's what's got the markets rattled.
The problem with Italy would be it's too big. I mean, you can rescue an Ireland, you can rescue a Greece, but you can't really rescue an Italy.
Over the last 3 months, Italy's 2 largest banks have lost almost 30% of their market value, with the sector hit by a large portion of non-performing loans. Government bond yields have risen sharply, no small matter when you're making payments on outstanding debts of $2 trillion, much of it held by the banks and financial institutions of Italy's European neighbours. The German Chancellor, whose banks are massively exposed, insists that austerity is the answer.
As far as Italy is concerned, it needs to send a very important signal by passing a budget that meets the need for austerity and consolidation. And in doing so, Italy will send a signal that it feels committed to consolidation and fighting debt.
Most of these countries that run up very large levels of debt, they have to basically start winding it back and doing it in a way that you might think, from the market's point of view, that it looks sustainable. So the whole issue is that you don't want to let these things get so large that basically the bank, or essentially nobody, can bail the government out.
Just how exposed the French and German banks are comes from data from the Bank for International Settlements, the central banker's central bank. It shows they have a combined exposure to Italian debt of €689 billion. The 2 countries' combined exposure to the other European strugglers, Portugal, Ireland, Greece and Spain, is €801 billion. The concern sparked a global stock sell-off. European markets lost ground, and in the US, the S&P 500 posted its biggest one-day fall in a month on the first day of the corporate reporting season there. Australian markets were not immune.
People have been saying to me, Chris, it's to do with the carbon tax. It's not the carbon tax at all. That does lead to the uncertainty, but it's the sovereign debt worries that are coming through front and centre at the moment, and that's the big situation.
Alan Oster says those ongoing concerns about the volatility in Europe are having a knock-on effect for Australia's private sector.
In our surveys, what we're seeing is basically business confidence falling back to levels we last saw when Queensland got flooded. So they're around about zero. So there's as many people saying essentially the economy is going to go backwards from here as those who are saying it's going to improve.
European leaders are frantically trying to contain the crisis, but as has been shown so far, events and the market move much faster than the politicians and bureaucrats.